Have you ever heard someone mention the S&P 500 and wondered what they were talking about? Maybe you've seen it on the news, or heard a financial advisor reference it, or noticed your retirement account is somehow tied to it. The truth is, the S&P 500 is one of the most important numbers in the entire financial world, and understanding it is the first step toward becoming a confident investor. So let's break down exactly what the S&P 500 is, why it matters so much, and how you can benefit from it. The S&P 500 is an index. Think of an index like a scoreboard for the market. Just like a sports scoreboard tells you the score of a game, the S&P 500 tells you how the largest and most established companies in America are performing overall. Specifically, it tracks 500 of the biggest publicly traded companies in the United States. These aren't small startups or obscure businesses. These are household names, companies like Apple, Microsoft, Amazon, Google, Coca-Cola, and JP Morgan Chase. The index measures the total market value, or what we call the market capitalization, of these 500 companies combined. When the index goes up, it means these major companies are growing in value. When it goes down, it means they're losing value. It's that straightforward. But here's where it gets interesting. Not every large company automatically gets into the S&P 500. There's actually a careful selection process. A committee of experts, mostly from the investment firm Standard & Poor's, decides which companies belong in the index and which ones don't. To even be considered, a company needs to meet strict criteria. It must be a US-based company. It must be profitable. It must have enough shares available for public trading. It must have a certain minimum market value. And the company's shares must trade frequently enough to be liquid, which means they can be easily bought and sold without huge price swings. When a company meets all these requirements and the committee votes to add it, that's a big deal. It gets noticed by investors around the world. But if a company starts to fail those requirements, or if it merges with another company, or if a better candidate comes along, that original company can be removed and replaced. This keeps the index fresh and representative of the strongest American companies at any given time. So why did the S&P 500 become the default benchmark that everybody references? Well, it wasn't always this way. For decades, a different index called the Dow Jones Industrial Average, which tracks only 30 companies, was the most famous market indicator. But over time, investors realized that 30 companies just weren't enough to capture the full picture of the American economy. The S&P 500, launched in 1957, offered a much broader view. 500 companies across different industries gave a more honest and complete reflection of how the entire market was actually performing. Another reason the S&P 500 became so dominant is something called passive investing. Starting in the 1970s, investment firms began creating index funds. An index fund is a collection of investments designed to track an index exactly. So if you buy shares in an S&P 500 index fund, you're automatically investing in all 500 companies proportionally. You don't have to hope one company does better than another. You're essentially betting on the average performance of America's largest and most successful businesses. And here's the thing. Over time, the average performance of those 500 companies has been really good. For an everyday investor like you, this matters because it means you have an incredibly simple way to invest in the American economy without needing a PhD in finance. You can open a brokerage account, which is just an account that lets you buy and sell investments, and you can purchase shares of an S&P 500 index fund with very small amounts of money. You could start with $25 if you wanted to. Once you own those shares, you own a tiny piece of all 500 companies simultaneously. If you're saving for retirement, building wealth over time, or just trying to participate in the growth of the American economy, the S&P 500 Index Fund is one of the easiest and most effective ways to do it. Think about what that means for you personally. Instead of trying to guess which tech company will be the next big winner, which bank will perform best, or which pharmaceutical company will discover the next blockbuster drug, you can simply own a piece of all of them. The 500 companies in the index are competing with each other, innovating, and driving the economy forward. When they succeed, the index goes up and your investment grows. When the economy expands and these companies become more valuable, you benefit from that expansion without having to make a single stock-picking decision. Of course, the S&P 500 isn't a guarantee that you'll make money. Markets go up and down, economic recessions happen. But historically, over long periods of time, decades even, the S&P 500 has delivered solid returns. That's because it represents the collective earnings, growth, and innovation of America's most successful companies. And those companies have a pretty strong track record of adapting, evolving, and continuing to grow, even through difficult times. One more important thing to understand is that owning an S&P 500 index fund is not the same as owning a stock in one company. You're not betting everything on Apple or Tesla or Netflix. You're spreading your investment across 500 different companies in different industries. If one company has a bad year, the others might have great years, and the overall impact on your investment is relatively small. This is called diversification, and it's one of the most powerful risk-reducing tools an investor can use. So to bring this all together, the S&P 500 is an index that tracks 500 of America's largest and most established public companies. It became the go-to benchmark because it provides a comprehensive view of how the American economy is actually doing. Companies get into the index by meeting strict financial criteria, and they stay in only as long as they continue to meet those standards. For everyday investors, the S&P 500 offers an easy, affordable way to invest in the American economy through index funds. You don't need a lot of money to start. You don't need advanced financial knowledge. You just need to understand that by owning a piece of these 500 companies, you're investing in innovation, growth, and the future of the American business landscape. That's why everyone talks about the S&P 500 and why it's such a smart starting point for any investor just beginning their wealth-building journey. The path to financial confidence starts with understanding the tools and instruments available to you. And the S&P 500 is perhaps the most fundamental tool in every investor's toolkit. It simplifies complexity, it democratizes access to wealth building, and it rewards patience and consistency over time. Whether you're 25 years old just starting your career, or 45 with children to support, or 65 preparing for retirement, the S&P 500 index offers something valuable to you. It's the embodiment of American economic strength and innovation. So the next time you hear someone mention the S&P 500, you'll know exactly what they're talking about. You'll understand that they're referring to a simple, powerful, and proven way to participate in the growth of the world's largest economy. And if you decide to invest in it, you'll be joining millions of other everyday people who have discovered that building wealth doesn't have to be complicated.